Hey everyone, it's Mike, and welcome to lesson number 1, all about point of control. And in this lesson, I'm going to give you the primer that you need to really understand point of control. So before I begin, a brief disclaimer: this presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right, so point of control. Now, in order flow, it's often also referred to as POC or VPOC, which is volume of point of control. And for simplicity purposes of this course, I'm going to simply refer to it as point of control. Now, in market profile, they also have point of control, which is the point in the profile that has the most TPOs, most time price opportunities. And it's kind of similar in the sense when you drill it down to order flow. Point of control is the price level in a bar with the most volume. Now, in a bar, order flow software is going to analyze the volume traded on the bid plus the volume traded on the offer at each price level. And the price level in the bar that has the most volume is considered the point of control. It's the point of control for that bar. It's nothing fancy, it's nothing sexy, it's just pure traded volume. You know, everyone always likes to have all sorts of fancy mathematical equations to try and figure stuff out. Point of control isn't any mathematical equation other than adding the bid volume and the offer volume. That's the only mathematical formula that goes into it. But other than that, it's just pure traded volume. And on a chart, it's going to have you need an order flow chart to see it. I'm sure somebody will come up with an indicator that you can just throw on a normal bar chart, but you know what, I'm so used to looking at a volume footprint chart, I wouldn't look at any other chart. It's going to have usually a black box around it. Now this is Sierra charts. Now in this course I use both Sierra charts and NinjaTrader. I'm not doing it to confuse you, but some users use Sierra charts, other users use NinjaTrader, and they're both kind of similar. One, if you're using Sierra charts, it comes with the program. It's called the footprint chart is called numbers bars. If you're using NinjaTrader, unless you have a paid version of NinjaTrader, now they just released some order flow tools. It's called Order Flow Plus when you buy their $1,000 software package. But if you're using the regular free version, you could get order flow additional software, like I have my order flows trader software. But any other software that has a footprint chart should show you, if it's any good, should show you the point of control. I mean, this is one of the basic parts of order flow analysis is the point of control, and it's highlighted in the bar with the box around the rectangle. Usually it's black, and you can adjust the colors, and it's going to give you a lot of information. This is Apple. This is the Apple chart here, I believe. Right here you can see Apple 30-second chart. And you can see each bar has a point of control. This is the Euro USD. This is the cash, the Forex market. And, point of control is probably the one piece of order flow analysis that I think you can use with equities, stocks, but, just the big stocks. If you're trading, thinly traded stocks, it's not going to be very useful. Order flow analysis is probably not going to be very useful on very thin traded stocks. Also Forex, it's the one piece of order flow analysis that I think is usable with Forex. And you can see each bar as well in Forex has a point of control. Now, like I said before, point of control is not calculated through some complex mathematical formula. It's actually the accumulation of trades going on in the market amongst the market participants. It's data in its purest form. It's actual trades. It bothers me sometimes, the way people like to distort the data. Just take the data as it is. The best way to describe what point of control is to think of it as the value of the bar that's trading. Okay, and when you look at a chart, it's a series of bars, each with an open, high, low, and close. But what your chart doesn't show you is the value of the bar, and that's where point of control comes in. It's going to allow you to see where the most volume in the bar traded and decide that is the value for the bar. Now, is it 100% perfect that that's going to be the value for the bar? No. What it's telling you is that's where the most volume in the bar traded, and generally that's going to be where people in that bar that were trading that bar in that time period, whether it's a 1-minute bar, 5-minute bar. That's where they decided they were happy to, most of the people were happy to transact in that time period. And to me, I represent that as value. And again, like I said earlier, point of control, the term originated in market profile. There's TPO analysis and there's volume analysis in market profile. And lots of times people put them together. They're kind of separate. And when you trade off a TPO analysis, you refer to the price level where price spent the most time as the point of control. In volume profile analysis, there's the volume point of control, which is the price level where the most volume traded. Just because time spent a lot of time, or price spent a lot of time at a price level, doesn't necessarily mean that's where the most volume traded. Okay, and I think that's where some people get misled. They think that, well, I see it was trading here for a long period of time. Well, there could have been, how do you want to call it? Not very liquid at the time. Maybe you got a release coming out, a data number coming out, or someone going to speak, and market's just going sideways, and it's not trading a lot. Whereas, when you're dealing with volume on a volume profile, that should give you a more accurate representation of where the most trading was going. Not that just price spent a lot of time at a place. Market could have been dead. Could have been the day before Thanksgiving or the day before Christmas break, and it's just nobody's interested in trading, and market's just going stagnant. Now, point of control and volume point of control both try to measure the same thing, value. The point where buyers and sellers are happy to transact because they believe the commodity is fairly priced. And again, that's why volume is important, is because, that's when you look at volume, that's where the majority of trade is occurring. Me personally, I believe that traded volume at price is probably one of the most important aspects of market data available to a trader. And most traders completely ignore it. They just focus solely on price. You hear everyone say, I'm a price action trader, especially in Forex. I trade in price action. And what good is focusing on price alone? You're going to be more accurate when you consider volume traded. And think of it in everyday terms, right? You own a store, you sell milk. There are 3 other stores nearby that also sell milk. If you price your milk much higher than all the other stores, you may sell 1 or 2 bottles. People that live right above your store that need milk urgently to feed their kid. But so they're not going to be so price sensitive, and you're not going to sell very much milk at that price. Yeah, you're going to think, well, I sold 1 bottle of milk here, and that's where the value of milk is. No, it's not. You only sold it there because people had a very urgent need for it. That's not what the true value is. It's not what the market is willing to pay, and that's I see the same thing in trading when people say I'm a price action trader. It's because, price spiked up here, so that must be even though it traded 1 or 2 contracts, then that's got to be where the contract's worth. No, it's not. It could have been an uptick. People don't really talk about upticks anymore now that there's no floor, but it's one of those things. It's not necessarily indicative of where the market is. And again, if you have the store and you price your milk too high, you're going to sell 1 or 2 bottles. Just like you go to Walmart, right? And you go into the store, you can buy a 6-pack of Coca-Cola bottles for now it's $3.33 where I live. It used to be $2.50, or that's 6 bottles. You could buy 1 bottle at the cashier. They got the little refrigerators there. 1 bottle is like $1.89. Okay, well the true value is not $1.89. They're not really going to sell very many. The point is not to necessarily sell a lot, because that's not what it's worth, because people know I can just walk to the back of the store and buy more. But they have it there because people all of a sudden are thirsty and they just want to buy it. That's not necessarily what the actual value of Coke is at that time. It's just people just impulse. So when I see people saying, well, I trade price action, I'm going to get into this when I talk about support and resistance. They're leaving out a very important piece of the trading puzzle, which is volume. And volume matters because it gives you the only accurate picture of market participation. Volume not only provides support for the market at lows, but also support on moves up. You don't often hear traders talking about moves once they're underway, but you need to follow through buying, for a move to continue up. Markets don't keep going up because you bought, oh, look, George, you bought 5 contracts. Great. Let's go take the market higher. No, what you need is, the consensus, the sort of the herd behind you coming in to help moving the market up. Humans, I believe, like horses, horses are herd animals. You're going to have some that like to run in the front, some that like to run in the back, but the majority run in the middle. And that's where the value is, if you sort of think of it in those terms. If you're not going to get the additional buying by other bigger, stronger market participants keeping the move going, then the move's not going to keep going. And point of control allows you to see that you have that volume to help move the market higher. The same is true of resistance selling. Markets stop and turn when there's strong selling at a price. Market could go up, strong selling come in, when you hit the high or just off the high, and then market moves down. All of a sudden, sellers are attracted into the market. James Dalton, who does, brilliant work on market profile. He describes price as an advertising mechanism. Price gets to a certain level, it's attracting buyers into the market, or attracting sellers into the market. If it's going higher, if it's going lower, it attracts buyers into the market. And that's how markets go up and down, is they're being attracted to the market either at high prices to sell or low prices to buy. And again, I'm a price action trader. Well, this is, what is it? We got Euro USD, right? This is the FX market. And markets sold off, rallied back up to these levels. Well, why? Why did it come back up to these levels? We all want to know, why do prices go back to a certain level? Why does a bar come back to exactly a particular level? And it's interesting, if you look at point of control, well, you got point of control in this bar here on the left-hand side. You draw the line out across, that's where price came back to. The next bar here, the second bar from the left, point of control came right back to that area. It's I don't know how to say it, without pumping it up, but it's a very useful tool for that. Price action traders, well, market came back up here. Okay, so now I'm going to wait for it to come back. Well, what if you knew that, oh my gosh, I've got a level here that we can come back to? You can be lying in wait here. You have offers just sitting here for those pullbacks to test those levels. And you see how the market came up, sold off. Market came back up, sold off. Now, traded volume versus intended volume, and this comes down to trading on a dome versus trading a footprint chart. People always ask me, what's the difference between trading on a dome and depth of market with price ladder as opposed to a footprint chart? Is a dome shows the depth of market. It's going to show where all the limit orders are sitting on the order book. And is that important? To some people it is important, but for me, I believe traded volume is more important, because the footprint chart is going to show you volume traded on the bid. It's going to show you the volume traded on the offer at each price levels. Break it down. What does a dome show you? It shows you the order book. It shows you traders' intentions. A footprint chart shows you trades that actually occurred. What do you think is going to be more important in the market? Trades that actually occurred, where somebody is now committed to a position, or people with orders above to sell? Honestly, if the market is 6 bid at 7, I would love to sell 12s, but the market's 6 bid at 7, so I'm not going to sell 12s until the market starts moving higher. And if it starts moving higher, I might not be interested in selling 12s anymore. So, while it looks good to see, wow, 1,000 lots offered there at 12, but the market's 6, 7, yeah, everyone and his brother wants to sell 12s. Maybe the market will shoot up there for a split second and come back down. Okay, chances of that happening are pretty slim, but if you've ever watched a dome, you see prices move around so fast that market 6, 7, there's 1,000 offered at 12. As the market starts ticking up 8, 9, 10, all of a sudden the 1,000 at 12 becomes 600, 300. By the time it trades 12, there's only 200 left on the offer there at 12, because those people have started moving their orders away from the market. So one of the ways highs are made is when prices are rising toward a high. Volume becomes reduced near the high, then increases sharply at the high. Now, again, that's not set in stone, but generally that's what happens, right? As you start going higher, what's happening? You're attracting sellers into the market. People are coming into the market and seeing these high prices and think it's a nice selling opportunity. That's what attracts the volume to stop the market from moving higher and start selling the market lower. And the same is true for the way lows are made. I should say low. should be highs, are made when prices are declining towards a low. Volume becomes reduced and then expands very sharply as prices make a bottom. It doesn't always stop and shoot up as a direct V shape, or for a low, or an inverted V for a high. Rather, oftentimes it just comes in and bottoms out, and you just see a lot of volume. You see price moving sideways at the low before going back up. It's putting in a low, and it's like a plane. A plane comes down slowly and then lands, right? It doesn't just come down at a straight 45-degree angle, or a 60 to 90, no, not 90, but a 60-degree angle or anything like that. It often starts coming in slowly, then then buying starts coming in. Markets are the same way. And if you're looking at point of control, you can see a bottoming happening here. People say, well, how can you know this is bottoming action? Well, you're looking at point of controls. Where they're appearing. They're appearing towards the bottom of the bars. That's important, which I'll be talking about later. That's one of the things you should be looking for. If you're coming into a low, where is point of controls? If we're coming in here, it's showing that there's support in the market. You got 1, 2, 3, 4 bars right here, right? As you're making these new lows, all the point of controls are towards the bottom of the bar. There is solid support coming into that market down there, just as near the highs. You get up here to the high, point of control right off the high, one tick off the high, sells off a little bit, comes back up, point of control right up near the high, sells off a little bit, makes another half-hearted attempt to go higher, point of control right up here near the high. And it's people that see the high prices, sellers coming in, taking the opportunity to sell. I mean, look at these, look at the bids. I don't know if you can see that, but it's 638 on the bid. This is the bid versus the offer here, 638 versus 271. There was everybody that was late to the party coming in, bidding up this market. They're bidding there. Sellers came in, hit those bids. Here you've got 594 versus 161. That's a strong bid there, and sellers came in and sold it. By the time you got down here, there's only 107, but it's the volume is there. There's offers up here, 230, 126 trade. So it's telling you that these prices have attracted sellers into the market. Point of control also shows the market bias. When trading above the point of control, the market has a long bias. Trading below the point of control indicates the market has a short bias. Take it a step further. When point of controls are migrating higher, when point of control in a bar is higher than the previous bar over several bars, market's often rallying. When point of controls migrate lower, it's a sign of a market selling off. And sometimes, like I said, people like to complicate trading, and it doesn't have to be so complicated. And if you look at a footprint chart, you can see our point of controls migrating higher. We come into this low, started rallies, just went sideways, then we see higher point of control, higher point of control, higher point of control, higher point of control, higher point of control than the previous ones. Now, what's also important to note is what's happening. Where is the market pulling back to? You notice you got the point of control right in here. This bar came right down. Point of control came right down. This bar got one tick past the point of control. This bar came right at the point of control. This bar 2 ticks above the point of control. This bar 3 ticks above the point of control. This is what happens in a market that's rallying. You're seeing the point of controls in each bar higher. Obviously, you got higher highs. That's one way to tell. But where is the market pulling back to? Point of controls are holding as support on a move up, just as they'd be holding on a move down. When you start seeing point of controls kind of jumping around, like down here at this low, it's a market that's going sideways. Or if you got point of controls sort of lined up around the same level, it's a market that's going sideways. So in pure volume analysis, it's been proven that when volume increases and prices rise, it's an indication that buyers are more enthusiastic. When prices decline and volume increases, sellers are enthusiastic. But point of control lets you take that thought of trading a step further, allowing you to quickly and easily see whether or not the heaviest volume area of a bar is moving higher or lower. And again, this is very similar to like what I just talked about with the point of controls migrating higher. If you're going higher, right, you want your heaviest volume areas to also be moving higher. If it's just jumping around going side to side, you got one low, one high, one low, that's just going to be a market that's going sideways. You want some uniformity, and you want it to coincide with what the market is doing. If one of the things that a lot of traders fail to understand is oftentimes when the market is supposed to do something and it doesn't do it, that's information that's just as powerful, if not more powerful, than if the market didn't do something, did what it was supposed to do. And I'm going to get that into some of the setups later. But what you're looking for is up bars with point of controls higher. If you're getting up bars with point of controls is just sort of hanging around each other, that's not a good sign of a healthy moving market. That's a sign of a market going sideways. Over here on the left hand side of the chart, you'll notice you got a blue bar, a red bar, point of control right at the same level. You'll notice how the market is just sort of going sideways. It sells off a little bit, shoots back up, and it sort of comes back down. What you're looking for on this move down, right, you're seeing down bars with lower points of controls. That's more of a sign of a market moving lower, just as the market that's moving higher with point of controls higher, 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 higher in each bar. Now, for point of control to work to your advantage, the market and point of control should be going in the same direction. It's common sense, but really, honestly, I think traders disregard common sense a lot of times. Like I said, they want to make things more complicated than they really should be. And don't overlook the obvious is what I'm trying to say, is the point I'm trying to make. Follow the point of controls. Follow the point of controls. If you had 1 point in a bar, some people like to key in on the open, some people like to key in on the close. Key in on the point of controls. What's point of control doing? Are we higher or lower than the previous bar? Are we higher and lower than the last several bars? What's going on in the market? Keep abreast of what's going on. I think that's going to help you in your trading. Find out, find direction, find bias, and hopefully keep you on the right side of the trades. So thanks. This concludes lesson number 1. In the next lesson, I'm going to discuss different ways to view a point of control. So I'll see you on the next one.